Welcome to Chart of the Day. I'm Nico Isaac. Fed re-examines its own ability to control inflation. So what next? Ever since the Federal Reserve Board was established, Wall Street and most economists see it as a saver of the economy. Its mystique conjures up a financial roundtable of monetary policy gurus. The Fed says its policies aim for full employment and stable growth. Specifically, the central bank pursues a 2% target rate for inflation. All of that said, a recent Bloomberg article titled "The Fed Doesn't Understand How Inflation Works" says that in fact the members of the Fed's roundtable are so baffled by the mystery of inflation that they've begun to re-examine their own strategies for controlling it. One certain measure clearly shows the failure of the Fed's best past practices. The Bloomberg article observes, quote, "The Fed adopted a 2% target for the core personal consumption expenditure index in January 2012. As the chart below shows, they've only hit their target in 1 month in the last 7 years," end quote. The Bloomberg piece goes on to suggest that the Fed doesn't control inflation at all, and instead may be more like King Canute, the 11th century leader of the North Sea Empire, who claimed to have supernatural powers as he stood on the beach thinking he controlled the incoming tide. For us, this recalls what Bob Prechter said in his 2009 best-selling book Conquer the Crash. Quote, "The deep flaws in the Fed's manipulation of the banking system to induce and facilitate the extension of credit will bear bitter fruit. For many people, the single biggest financial shock and surprise over the next decade will be the revelation that the Fed has never really known what on earth it was doing," end quote. Case in point, our Currency Pro Services editor Murray Gunn offered subscribers clear evidence of just how far the Fed is from reaching its inflation target. Quote, "Ever since the financial crisis, the entire focus of central banks has been to stave off falling prices. Try as they might, though, consumer and producer prices have simply not accelerated in the way they want. The chart below shows the amount of debt outstanding in the world that has a negative yield. It has just surpassed the 10 trillion mark for the first time since 2017. According to this data set, the high was just over $12 trillion in 2016, end quote. How does this all fit into the bigger picture of the US economy and the global economy at large? The March 26 analysis by Murray Gunn is available right now as part of our Currency Pro services. See below for more.